Howdy guys, welcome back to another episode with the Fi Guys. Today we're talking about insurance with Mark Massie. And with that being said, let's get right into it.
So recently I've been getting a bunch of different calls from individuals asking me, Chris, when do I need to get life insurance? How do I protect my income? If I do get insurance, how much do I need? So today for the podcast, we brought on Mr. Mark Massie, someone with over 20 years experience in the insurance industry to help answer these questions for our audience members and for clients of Monzon Wealth. So Mark, I'd like to hand over to you. And could you please, before we get started, just tell the audience a little bit about yourself?
Sure. Glad to be on board today. Enjoyed working with you, Chris. Always happy to be a resource for you guys. So a little bit about me. Started in the business with a captive carrier, one of the big mutual shops back in 99. Switched over from being a financial representative doing asset management and insurance to wholesaling. Worked with a couple of the big firms on the mutual fund and the variable annuity side. Then got into the brokerage space where I work with individuals like Chris and other advisors, mostly more advanced planners, and have worked on the national key account side, worked on the retail brokerage side. I do a lot of work where I am the insurance resource for an advisor who doesn't specialize so much in insurance, specializes more in the asset management, and they bring me in as the resource to help them with the I got a guy question.
Mm-hmm.
So that's the short and sweet of it, but have worked on the insurance side in life insurance, annuities, variable annuities, fixed annuities, disability, long-term care. So there's not an insurance topic I haven't touched outside the PC, property and casualty world.
Yeah, I've been working with Mark for quite a while now, and he has been my go-to resource for anything insurance related. My clients have just been able to love to speak with him for him to able to bring up all of the different things. Now, Mark, you mentioned something earlier. You said that you used to work for a captive insurance agency. Can you tell our audience what that means?
That means that you are a representative of a specific insurance company, whether it be a Mass Mutual or New York Life, Northwestern Mutual, Pac Life, one of those kind of a companies. So those companies are represented by agents or insurance representatives, and your first foray is to shoot the business of that carrier. Now, if they can't underwrite that or they don't have a product that fits that client from a suitability standpoint, you have the opportunity to go out and shop other carriers, but your business is first and foremost going to go to that carrier. So I left that role because I wanted some more independence to be able to do the right thing for my client and not have that kind of over my shoulder. So
Interesting. So you talk about like doing the right thing for your client. I'm kind of curious, like what are some common misconceptions that people might have about insurance?
Well, it's actually a topic that's out there right now. The Department of Labor has put out a new fiduciary rule. This is their third attempt to do it, where they're trying to make insurance advisors or insurance agents. They don't like us using the word advisor. Again, a play on words. They don't want us selling high commission products, and high commission is a subjective word, to their clients without having some kind of a securities background. So, we just worked on a case with Chris where it was a fixed indexed annuity. It was absolutely the right tool. We actually did two of them for the client. It provided that client with an ability to supplement her pension with guaranteed income she can never outlive. She's got a guaranteed fixed rate of return. So even if the market tanks, she's going to flatline during that year. She might not get as much on the upside. If the market goes up 20%, she might get 10. But when the market's down 20%, she's at the water level mark and getting zero. So it's the difference between an average rate of return and an actual rate of return. And you're going to find if you go and look at a fixed index annuities index performance against the S&P in an open market, whether you can go negative, your average versus your actual rate of return is going to be in many cases higher using an index. But the important thing there is she's got an income she can never outlive. Even if her account goes to zero, meaning that she spent more money than she put in, she's guaranteed until the day she leaves this earth that she's going to get a check for a specific amount, which helps her in planning and gives her flexibility on the other things that she's doing in her life.
Yeah, I could see how someone would really, especially someone in their older age who doesn't like risk, who wants that stability. They don't, they want to get off the roller coaster. They want a nice, simple train ride. We don't need the Incredicoaster or anything like that.
Well, it's creating what a lot of insurance agents have termed a personal pension.
Mm.
You know,
Oh, I
the
like that.
days of going to work and working for a company for 40 years and then getting a pension and the Rolex when you retire are gone.
Yeah.
You know, how many jobs do you know from the 35-year-olds you're working with? How many jobs have they switched? Okay, somebody my age, I'm north of 50. You know, the idea that I'm going to work for that same company and get rewarded with a pension, well, that's that's the role you're looking at in the military. My
Mhm.
sister's 28 years, been in the Navy for 28 years. She's looking to go 40. When she hits 40, she gets 100% of her base commission or base salary for the rest of her life, and her health care is paid for. But how many people want to go that military route for 20, 30, 40 years?
Yep.
Mhm.
Well, it's a
Yeah,
calling.
it's tough, especially for our age demographic. And one nice thing I want to say about that client that she helped me with, she actually retired a little bit over a week ago, so she's
Right.
at this
And
point
we were
fully
looking at her
financially independent.
retiring originally next January,
Yep.
and she was a
Wow.
stretch for her to do that.
Mhm.
Wow.
And because of the tools and the things we put in place, she's drinking pina coladas now.
Yep.
Wow.
She really is. I just talked to her recently. So that's a little bit for when someone's getting towards retirement. But for a majority of our demographic that we reach here from looking at our analytics, it's younger people, millennials. And the thing that I'm getting most calls from regards disability insurance and life insurance. So,
Okay.
Mark, when should a younger person, maybe a millennial, Gen Z, Gen X, I can't remember what they all are. I think Gen X is older than us. But
Mhm.
when should they begin to consider insurance as a viable option for them?
Well, it's a loaded question. It all depends on the situation the individual finds themselves. If you've got a 35-year-old and they've got a couple of children at home, they've just taken on a mortgage, they've got a good career, then that situation is completely different from somebody who's 50 years old or 22 years old, like my son who's in college. Now, we're looking at right now taking out as much as we can in insurance for him on a 20-year term policy. We'd like to get $1.5 million for him. He doesn't have any kids. He doesn't even have a job yet, other than the lawn care business he started. But what we want to do is protect his insurability for the next 20 years because he's got perfect health right now. So when he gets to 25, 27, 30 years old, and he wants to do some planning, he's got the ability to convert that term contract, which is basically renting insurance, into a permanent contract, and he doesn't have to go through underwriting again. So you think about that in what we've gone through with the recent pandemic, and some people, they've got COVID, and now they've got some heart issues, myocarditis being a big thing in your demographic. That person's now probably not insurable. Whereas
Wow.
6 months ago, he was perfectly fine running around playing basketball, playing football, and now he's got a heart problem that's going to linger for the rest of his life. No insurance carrier is going to touch him, or if they do, it's going to be a highly rated, much more expensive case with certain parameters that client's going to have to fit into.
Interesting. So just a quick question. So how does so he's 22 right now, gets to 30. You talked about using that for life planning. Like, could you go more in depth on that?
Sure. So I'm 53. If I'd have taken that policy out when I was 22 years old, or even taken a 20-year contract out on a term policy, we keep hearing the term or the phrase buy term and invest the difference. We hear that from these talking heads, the Dave Ramseys and people like that. Okay. So I'm 30 years old. I take out a 20-year term policy. What happens at 53?
Nothing.
I don't have it anymore.
It's gone. It went away.
Yeah.
And my cost to get that contract renewed at 50 years old, when that 20 years is up, is much higher. And if I've had any health issues, forget it. So what you do is you convert, you protect your insurability so you can convert that contract. And what that means is you go from a term policy to a permanent policy. You pay the difference between the term and the perm at that age, but there's no insurability risk. You're guaranteed to be able to get that contract. So what does that mean from a planning standpoint? Well, it means you've got a guaranteed insurance as long as you pay the premiums for, as long as you want to keep that policy. You've got living benefits within that policy, certain contracts that are out there, the IUL contracts that your demographic's probably hearing a lot about on TikTok and Instagram and some of these other social media platforms, is the infinite banking system, and using life insurance to become your own banker or to reduce your debt. Well, if you don't have a convertibility and you've had a health problem, all of those options are off the table. So this protects his insurability going out until he's 42 years old. Hopefully we're going to make some plannings, decisions before that happens. But the options that you have in being able to convert to that permanent product just open up your world to be able to do more things on the assets under management side, on the brokerage side. Maybe you can take some more risk in the crypto market because you have that floor covered. And it's the same thing with disability. What we talk about with the younger clients is, the catchphrase is everybody needs a hug. So what is a hug? Okay. A hug is housing, utilities, and groceries. Your basic needs, you're covered. If you look at a pyramid or a hierarchy of what you need to cover in financial planning, this is part of the CFP that Chris knows very much about. The basic first course in there is risk protection. You got to protect your risk. So you go to work, you're drawing a salary, you've got a car. If you're doing really well, you've got your home, your boat, you're traveling. What happens if your income stops? All of that goes away, right? You can't pay for the home. You can't pay for the car. You can't pay for all these other things. Well, those things are worth value to you. So what do you do to protect your home? What do you do to protect your car? What do you do to protect your iPhone or your Samsung? Think about what do you do to do those? You buy insurance, okay? So people say, well, maybe I can't afford it. Well, let's think about this. How much are you spending on your coverage for your mobile phone? You got a brand new iPhone 15. What does that cost you every month for insurance?
I've never bought the insurance, so I have no idea.
Because you're in the market. You know what it is.
Yeah, we're both in the market.
Say it's $10, $12, okay? So if it's $10, let's be conservative. That's $120 a year, okay? What do you get for that? Well, if you lose your phone or you break your phone, you still have to pay a deductible to get a new phone. So you're probably out of pocket another $50 or $100 for the deductible. So people don't have an idea of what they're actually spending their money on. So what we want people to understand is you need to protect the one thing that funds everything else. So what is your most important asset when you're young?
Time.
Our ability to work, our time.
Your income.
Yeah.
Yeah, your time being exchanged for a return. So your investment is your time. The return on your investment is income, which funds all these other things we're talking about. Most young folks are under some type of a group disability policy if they're working as a W-2 employee. If they're a 1099, in many cases, they haven't even addressed this.
Yep.
But having some type of a disability insurance, whether it's short-term or long-term, most group policies are a short-term disability contract. They're going to cover you for 6 months. Okay. And it's usually 60% of your base income. Some of them will take a look at your making bonus or commissions and they'll do, kind of an adjustment on that. But they usually look back 2 years on what you've made. My suggestion for most of those individuals is take a look at the cost for that group insurance, because if you have a policy that your company's paying for, the benefit that you get is going to be probably 60% of your salary, and it's taxable on top of that.
Oh, I didn't know it was
now
taxable
you went
as well.
from making, I'm just making up numbers here, $100 a month. Now you're getting a benefit for $60 a month that you're going to be taxed on. So what are you really netting?
45, 50.
Yeah.
There you go. Can you live on that? If you were living like the Joneses, trying to keep up with the Joneses, spending 105 when you're making 100. Again, we got to look at the demographic we're talking about, right?
Yeah, it's tough. So let's bring up a case study. So I currently have 2 clients that I've spoken with you a little bit about, Mark. They're mid-30s. They have 1 kid, and then they're on the way for a second kid. At this point, they have no coverage that I'm aware of. Where should they start? Would disability insurance be the first thing to start out? Life insurance? And if both of those or neither one of those, how much coverage should they put on those, saying that they're making roughly $150,000 a year between the 2 of them?
Okay, it goes back to the everybody needs a hug concept. Let's make sure that your primary base bills are paid, whether or not you're above ground or below ground, breathing or not. Okay, and it doesn't matter whether there's a second income in the house or not. Obviously, if you have a second income, it helps, but that's not going to make a determination, because most of those second incomes are being pulled jointly to afford the lifestyle that they're in. Okay. So the first thing I would say is make sure you're covering housing, utilities, and groceries. Okay. With that, there's some other ancillary things you want to make sure you're covering: your car payment, your things like that. So I would say when we're looking at putting this kind of a HUD program together, we're looking at doing a disability policy and an insurance policy, which is usually term,
Mhm.
for less than or right around 2% of their gross income. So it's not a huge expense.
Okay. Is that a month or is that a year?
You break it down. Yeah, it could be a month or a year.
Okay.
It's the number's not going to change, just whether you're paying it annually or monthly.
Mhm.
So
Mhm.
I just looked at some numbers before coming on here. I ran a quote for an individual who was, I think, was born in '95, so it'd be what, 29 years old now.
Mhm.
Okay, $1 million, $29.17 on a convertible
Wow.
policy.
Wow.
Okay, and that's a preferred non-smoker. So even if it went down to standard, you're looking at 35. Okay, we get that a disability policy in place, short-term and long-term disability, for again probably around 1 to 1.5% of their gross income, and that
Wow.
would cover them all the way out to 65. And there's
And then
different
how?
types of different disability policies you can get. If you've got a professional who is, let's just say, somebody who's working with their hands, a surgeon, okay, we can get what's called own occupation, and that'll cover them all the way out to age 65. So if the surgeon can't perform surgery for whatever reason, he can still go into another occupation. Maybe he becomes a consultant or an instructor, or does something else in the medical field, but he can't perform surgery anymore for whatever reason. He's going to get a percentage of that income all the way out to age 65,
Mhm.
and then he can go on and do something else. Now, that's an ONOC policy. That's the richest policy there is. There are other policies that are just in there for that short-term need. Okay, I broke my leg and I'm going to be out of work for the next 2 months because I got a full cast on and I can't put any pressure on my leg. That policy is going to be a lot less expensive. But again, that's probably going to run out after 6 months. So you got short-term that runs about 6 months, and then long-term, which will be that year plus, going all the way out to age 65. And if you're on disability, some of those policies will allow you out all the way out to age 70. It just
Okay.
depends on the carrier. And there's a ton of different ways to structure it. That's why you need to work with Chris, who's working with somebody who's been in the industry for a while and can go out and shop that. We go to my job is, as I'm a brokerage guy, you give me the particulars. Chris calls me and says, I got a guy. Here's what he needs. I go out and find what are the best, the top 3 most suitable solutions for that. And then we sit down and we go through that with the client.
Mhm.
Interesting.
That's the route I would go for that individual who's 30 years old, starting a family, has a good income. Got to protect the income, and you got to make sure that income's covered, whether you're still here or you're injured and you can't continue to work for either a short period of time or a long period of time.
So what does that happen if? At what point, how much coverage do they want to have for, say, a life insurance policy if they were to die and then, say, both spouses were working? I think that's the
Mhm.
biggest concern I've gotten is how much coverage do I need if I was to pass away? Say I'm making
Okay.
$100,000 a year. I have a kid that's 2 years old, another kid on the way. How long do I want to make sure that my income is covered for? Or how much money do I want to give my partner now that I'm dead? Because
Mhm.
a lot of people don't think about that when I pass away, that's not now 50% of the costs are now gone. You still
Right.
have to care for your babies. If anything, it's even worse now because now you don't have that partner
Great point.
to.
Great point. So obviously it's going to differ per individual case. Okay. But if you were to take the base case, you want to replace that income. Let's say he's got a child that's 1 year old or 1 year old. Okay. We want to replace that income that he's making. So he's making $100,000. We want to get a policy that's going to kick out $100,000 until that child's at least 18. If you're planning on going to college, call it 23. Well, some colleges going out to 26 now. But
Yes.
okay, so that's just your income piece.
Mhm.
Then you got to decide, do we want to pay off the house? Do we want to fund the college? Do we want to set up some type of a trust so he can do things or she can do things that dad would not be or mom would not be able to hear to help them do? Do we need to, is mom or dad, the surviving spouse, working? Well, now we got to worry about, potential childcare. So what are those expenses going to be? And this is a hard conversation for young folks and older folks to have. I'm dealing with it. I've got an 81 and an 82-year-old father and father-in-law, and mortality's starting to set in. They both lost their spouses.
Mhm.
But to sit down and have these conversations is a tough thing to do because they're closer to, that mortality than somebody is when they're in their early 20s or even late 30s. It's much easier to have that planning conversation, I think.
Mhm.
The problem is you've got to sit them down and get them to have it. And they've got to actually sit through. So what I normally do is I have them envision, okay, you are driving home from work and that drunk guy crosses the yellow line. I've got this case in my, I've got a high school friend who went through this, okay. Guy crossed the yellow line. Dad's out of the picture. Mom's got 2 young kids and she's still going through school, finishing up. Okay. What needs to happen? Well, we got to fund mom's education. We need to pay off the house, hopefully, or at least provide money to pay the mortgage, guaranteed. We've got to have income replacement for that surviving spouse to be able to continue doing the things that the income from the deceased spouse was covering. And then we got to figure out what are the other things that we're going to need to pay for.
Mhm.
So that number can be daunting. Okay. That number might be $1.5 million or $2 million in coverage. That's where term insurance comes in because it's relatively inexpensive. And then you can start doing the planning and going forward. And when I talk about converting that policy, say we've got $1 million policy, we can carve out $100,000 and convert a piece of it this year. You don't have to convert that whole thing at one time.
Mhm.
So
What
it
do you mean by
allows you to
convert?
do the planning that you want to do.
Okay.
Okay.
So the convert, I that's one of the things in my notes. Actually, I was hoping that we could get back to.
Mhm.
Like you said just now, you got $1 million policy. You can convert 100,000 of that this year if you needed to.
Mhm.
What do you mean by convert? Right? Could you go into more detail on
Yeah,
that?
you take a term policy, which is a rented insurance policy, and then you take that. It's like renting to own a house. Okay.
Okay.
So you carve out a piece of that or all of that, and you literally take term insurance and turn it into permanent insurance. And you're usually doing that with the same carrier, but you don't
Okay.
have to go through the financial or, more importantly, health underwriting again.
Okay.
All you're doing is saying, okay, I bought this policy when I was 25. I'm now 35. I want to convert it, and you pay the price at 35 years old, but you're still paying the price that you got for the health underwriting at 25. So if you've had some type of a health problem between now and then, it's off the books. They don't even look at it. It's
Gotcha.
literally a transaction.
And for those certain policies, what do you look for when, like you said, that convertible, something that
Mhm.
converts into something permanent? Is that a specific policy type, or are they all convertible, or how
They
does
are
that work?
not all convertible. You want to make
Good to
sure
know.
when you're buying term insurance, you're buying it from a reputable carrier. Typically,
Okay.
we're looking at one of those that has an AM Best rating of A- or higher. Okay. Doesn't mean that there aren't good B+ carriers out there. There are a lot of carriers today that are A-rated carriers that were B+ 5 years ago, just because they were new in the market or they changed reinsurers. So you got to look at what's called the RBC. The RBC is how much risk do they, or how much reserved capital do they have to cover the liabilities that they've got on the books.
Mhm.
Okay. You want to look for a carrier that's got an RBC north of 800. Most of the A+ carriers or A- or above carriers, they're north of 850, 900. Okay. And that's where you come to a resource like Chris, and I'll help him out with that.
Yeah, absolutely.
You want to look at what, not only is it convertible, but what kind of contracts is it convertible into? Is it a whole life? Is it a guaranteed UL? Well, you don't need the guaranteed UL because you've already got the guarantee in your term. So maybe we're looking at a whole life, dividend paying contract with a Mass Mutual or a John Hancock or a Lincoln Benefit or Security Mutual, one of those type of companies. Or we're going from term, not to whole life, but to index universal life, which is what your demographic's hearing a lot about again on social media. And that is a Swiss Army knife of life insurance because you can overfund that policy. You buy a lower death benefit, you put more money in than what the actual death benefit, the cost of insurance is. And there are certain limits. There's a thing called a MEC, a modified endowment, where it becomes not a life insurance policy anymore. Okay. You want to stay under those thresholds. But that builds cash value And with that cash value, you have living benefit options that you can use that for, whether it be long-term care at some point down the road, critical illness. If you've got a bunch of cash value in there and all of a sudden you've got a transmission you've got to replace, you don't have to go to the bank. You don't have to hit the credit card. You can take a policy loan. And it's tax-free money.
So you'd be paying yourself back, and it would be tax-free.
Correct.
Because it's a loan to yourself. Okay.
Correct. And if we're doing this in a retirement scenario, we're overfunding this for, a number of years, and we get to retirement, that money comes out in retirement in the form of a loan, but that doesn't have to be paid back. They take that out of the death benefit. And that's really important when we get to the retirement folks, when we're looking at what are the sources of income, because what a lot of pre-retirees don't realize until they're in retirement, that is there's a thing that came around in 2013 or 2003. And it's called IRMA. And that is a surcharge. And we actually dealt with this with Chris, with one of his clients. The income that individual thought she was going to get from retirement, from Social Security, she got it. But in turn, they took around and took money out of that benefit. It's not really a benefit, but you paid for it. But they took money out of that to turn around and pay her Medicare bills, both her base Medicare and her supplemental Medicare to cover the hospitalization. And it's called Medicare Part B and Part D. If you make a certain threshold of income and that income comes from certain sources, usually qualified sources, 401ks, 403bs, your IRAs, they count that money towards that. If it's coming from a life insurance policy, that's not counted in the means testing. So it actually lowers your tax bracket, keeps your surcharge, if there is one, on your Medicare much lower. So your taxes and your healthcare costs through retirement are affected by where your money comes from at certain thresholds. Okay? That makes sense?
Yeah, definitely.
Okay.
Definitely makes
sense. And that's part of the planning that we want these younger folks to look at is, yes, we want to build a bucket of money to pull from in retirement. That's what a lot of financial advisors are very, very good at. What a lot of them are learning they need to understand better is how to decumulate that bucket they've accumulated over the course of their working years in the most tax efficient manner and in a way that doesn't affect their IRMA. And now most people that are our age or your age, I would say, are saying, well, I'm not counting on Social Security. I'm not. But I am looking now at how that's going to affect my other sources of income, because if all of a sudden I've done a very good job for planning for retirement and I'm in, say I'm making $200,000, $300,000 a year in retirement, I'm not getting a Social Security check. Okay, I'm fine with that. $3,000 a month tops, maybe $3,500. But what I am concerned about is the fact that that money's being taxed at 85%. And it's putting me into an IRMA bracket where my Medicare costs are much higher than I thought they were going to be. And my premiums are higher than what's coming out of my Social Security check to cover them. So now I've got to go pull money from something else to pay for that. And that's going to cause another taxable issue, which means 2 years down the road, because there's a 2-year look back, I'm going to get charged even more on my IRMA. If we do proper planning at 40, 35, 50, and we put annuities, we put life insurance, we put Roth IRAs in place, we look at there's only 5 things that aren't counted. Money coming from a life insurance policy, certain money coming from what's called an exclusionary corridor in an annuity, whether it be a fixed annuity or a variable annuity, money coming from an HSA or a 401h, a term most of your audience has probably never heard of. It's made for small businesses, or money coming out of your home, whether it's a HELOC or reverse mortgage. Anything over that, okay?
And a Roth.
And a Roth, yeah. So, I invest in muni bonds. Those aren't taxable. Right, they're not taxable, state or federal, but they are counted towards IRMA. Okay? So that's the part of the financial education most people don't look at. There's an old saying, most people, until they get to retirement, spend more time every year planning their vacation than they do looking at their finances and understanding where their money's going. And that's why they're getting eaten alive by fees.
Yeah. And IRMA is a particularly dubious one because it's almost a fee for doing too well, for making too much money, for saving too much, and for trying to plan out well. But you just were unaware of this one thing that if you make too much money, now the federal government's going to tax you, quote unquote tax you, but charge you a fee for making too much money in retirement.
Right. And they are going to tax you because your Social Security income is taxable. They're taxing it a third time. And they will tax it up to 85%.
So IRMA is a fee from the government, correct?
That's how they are funding the unfunded mandate.
Gotcha.
When we say Social Security is broke and Medicare is going broke, technically it is, but where do they fund it from? Our tax money. So they just raise our taxes, raise our fees, and find another way to do an end around on it.
And is the IRMA, is that like a fixed number? Is that variable? Is it depend on the person?
There's brackets.
There's brackets. Okay.
Yeah. So where a lot of people get in trouble, and I'm dealing with a case with this right now, they were right at the cusp, $194,000 as a couple. So they weren't in IRMA yet. Okay. But mom passed away. She predeceased dad. Their income did not change. Okay. He gets a little bit less in Social Security because she's not there. They had both worked their entire life. Okay. But the money in the other buckets outside of Social Security, that didn't change at all. And actually, he got some life insurance, which didn't count, but it added towards his bucket of money that he's going to pull from later on. That's not taxable. But now that he's not a joint, two-person couple, he's single. Now that $194,000 threshold dropped in half. So now he's in IRMA. So his Social Security income just took a big hit. Okay.
Yeah, it's very difficult. And I think that complexity is one of the biggest issues that I find as a financial advisor trying to help people along this path. I have an acronym for when I'm doing my financial plan. It's RETIRE. And that first R stands for risk mitigation or risk management, trying to make sure that we find the right insurances. But I find that more people, they want to get into that first E, the expense management or the taxes. They want to focus on that. They don't want to talk about this risk mitigation because first off, it's scary. And number two, it's extremely, extremely complicated. As we just showed here, trying to have a quick conversation about where to find, how much money should we even put aside for somebody? So the first step, would you agree with me, Mark, is to first get a term policy if you have someone that is dependent on your income or someone that's dependent on you or maybe dependent on you in the future. That way you have that optionality open to you in the future to maybe convert to an IUL, which for our audience means index universal life or a whole life policy.
Absolutely. And buy as much as you can qualify for, because you have no idea what your income's going to do now versus 5, 10, 15, 20 years later. So if you can buy a chunk now, $1.5 million, $2 million a term now, buy it. It's cheap. Buy it from a quality carrier that's got convertibility. Put a waiver of premium rider on that so that if for some reason you can't afford to pay those premiums because you're sick or you're hurt, you're permanently disabled, the insurance carrier picks up those premiums. And even if you convert it, they pick up the premium. And that's one thing I see all the time is I'm trying to get the cheapest insurance I can. That's great. Buy cheap insurance, buy that term policy, but make sure you have that extra protection on it with what's called a waiver of premium. If you're hurt and you can't afford to pay the premiums, the insurance company will pay those term premiums for you. Okay.
And that typically does come with an additional cost, just for our audience members to know, but it is
$2 or $3 a month.
Interesting. And what was that called again?
Waiver of premium. WOP. Yep.
Gotcha.
So, and here's something else to talk about with your when you're talking about the first thing is risk mitigation, but they're worried about expenses. What is a CPA's job when you go and meet with them on an annual basis to do your taxes?
To try to have the least amount of taxes paid each year.
Each year. They're looking at what can I save you today? Now, this is not a diss on CPAs. They're doing what their job is. They're not looking at 10, 15, 20 years down the road. They're not looking at retirement. They're not trained in insurance in many cases. Okay. So it always boggles my mind when we have somebody who's got a CFP like Chris and their client goes to their CPA and their CPA puts the kibosh on an insurance plan and says, no, don't do that. Buy the cheap thing. Why? Because he's trying to save you money today. And,
there might even be times. Yeah, there might be times where you ask your CPA, should I do this Roth conversion this year? And they're going to say, no, don't do that. That's going to raise your taxable income. That's going to be more taxes.
Mm-hmm.
Where maybe in 30, 40 years, if that Roth had grown, that's so much more money in the future. And that's the difference between a financial advisor who's looking at you holistically versus going to an individual like a CPA who's looking at it. How can I save you money right now? You go to someone who only focuses in insurance. How can I do insurance right now?
Right.
That's where you want someone who can take the entire picture. And that's why these conversations, they're very nuanced. And, Mark, I know that there's a lot of people right now who they're going online and they're just purchasing term insurance for the cheapest price that they possibly can. And I mean, they're getting something, which thank God they're at least getting something, but
True.
Is that the best way to do it? Or should they really try to reach out to a qualified planner like myself or to any other fiduciary who's there to help them? Or should they just kind of MacGyver this from their own standpoints?
Well, what a lot of people don't understand is when they're going online and doing that, it's not like buying car insurance from Progressive. Even with dealing with a Progressive car insurance or Geico or something, like, you still have to have a broker in place. There's an agent handling that for you. Okay. So they're getting paid a commission for you going online and doing the work yourself. Why not use an advisor to make sure that you understand what you're doing? So the short answer to that is I would always work with an insurance agent or a financial advisor that either is versed in insurance or has a relationship with somebody that can help them out. Because as you said, it's very dynamic case to case, and you cannot be a specialist in everything. That's why Chris is smart. He's surrounded himself with people who are experts in the certain areas. He's the spoke, and he's got resources on all the hubs on the wheel. That's the smart way to do it.
Yeah, I try not to be everything to some people. I try to be.
You can't be, because then you end up pounding a square peg in a round hole.
Absolutely.
Okay? So there's a reason, going back to what we started with, when you look at what you're seeing on TV. I mean, we were just watching the Final Four. I probably saw the commercial for the certified planner, CFP professional, a half a dozen times. The first pillar in studying for the CFP is risk management and risk mitigation. It's insurance. Okay. There's a reason that's there. When you're building a house, what do you have to put in first?
Foundation.
Exactly. Okay. You can have all the bright, shiny things at the top of the pyramid, but guess what? If the foundation crumbles underneath it because you haven't done the proper planning and you haven't put the reinforcements and the rebar in and the concrete's weak, it's going to crumble.
Absolutely.
Okay? And this is what people are not being taught in school. Okay, most high school graduates can't balance a checkbook. That's sad. Okay,
Crazy world.
I think
one
it
of
also
the things
makes.
I work with is called junior achievement, and we actually go into the grade school or the junior high and high school level, and we teach them business basics and financial planning basics. Chris, if you can volunteer some time to that one, look for it. It will be rewarding for you, and it will be instrumental for the children that you're talking to.
Let's talk off the pod about that. I'd be very interested in helping people because I've talked on the pod about my backstory and not knowing anything about money, basically growing up poor and figuring it out through a lot of trial and error, a lot of issues. So I think the quintessential hero story, not to say that I'm a hero in any way, shape, or form, but is that you went out, you went through the jungle, you went through these things, but most importantly, you came back to teach others to not have to make those same mistakes that you did. And this is kind of leading into
the exact number. It's under $150 a month. But you start teaching these kids, the day you graduate from college at 22 years old, if you start putting $150 a month into an indexed return fund, an S&P 500 index, and you just keep putting that 150 every month. I can't remember how many years it is. I want to say it's like 20 years. You're a millionaire. That catches their attention. And then you show them how to do that. It's
called you do the power of 72.
Exactly. Rule 72.
You do the power of 72. You do it a few more times, and by the time they're ready to retire, in those first 20 years, did they make a little bit of a sacrifice? Yes, but they retired multimillionaires because they have that power of time on there.
Right. The greatest invention ever uncovered was the power of compound interest. So tell your audience what the Rule of 72 is, because a lot of them probably have never heard of it.
Yeah, so the Rule of 72, and then there's also the Rule of 105, but the Rule of 72 is you will divide the expected amount of return that you're going to get by 72. So say you do your expected return in the market or in a whatever it is 10%. Well, if you divide 10 by 72, then that gives you 7.2%. So every 7.2 years, your money doubles. So you went from $100 to $200, and the next 7 years comes, that goes to $20. After that, $20, $40, $80, $160,000, $320. And we can see how this this snowball grows and grows and grows. And that's only saying that you put in money in once. Imagine if you're also putting in money continuously. And that's the power of set it and forget it. That's the reason that people work with me here at Mons on Wealth, is because we can set up a plan that's easy to go. And then you're basically focusing on your life, focusing on your family, your kids, going out to sports, whatever it is, knowing that when you reach retirement, your money has been set up for you because you put the hard work in at the beginning, where most people don't think about it until they're 55, 60 years old.
Yep. So the short and sweet of it is, if you get a 7.2% rate of return net of fees, which is again why you want to work with advisors, so you get eaten alive on fees, and you let it grow for 10 years, you're doubling your money. If you're getting 10% rate of return, you're going to double your money in 7.2 years. It's that easy.
Interesting.
Makes it a really simple concept. Dominic, you get that, right? You're not in financial services. That's easy to remember.
Super easy to remember. Super easy.
So the other topic we were going to talk about was, with all this planning, how do we get into using that life insurance to do some things? And we've discussed IRMA a little bit, but IRMA is part of what's catching a lot of fire on the internet again these days. It's called the infinite banking system, or becoming your own banker. And there's two paths that you can do that. You can do that with whole life, and they usually use that for debt reduction. So you're overfunding a policy. And by overfunding, I mean you're paying more than the insurance costs. So if your premium's $100, you're putting in $300, let's just say. So that $200 is going to work, and you're earning a dividend. And there's a floor on a guarantee on that dividend every year in a whole life contract. Doesn't mean you can't earn higher, but you can't go lower. Okay. And your insurance is going to be in place as long as you're paying those premiums. At some point, there's enough cash in there that if you want to turn off the premium flow, it'll continue paying that insurance for you. But as you're paying the premiums, you're growing your dividend. So if you make it very simple. If you've got $1 in and you earn 10%, now you got $1.10, they're going to buy you $1.10 of insurance that following year. So your insurance is going to grow. Then you're going to earn interest on that $1.10 the next year. That's the compounding. So it never goes negative on the cash, and your death benefit continuing to grow if you structure the policy correctly. On the index, and what you do is you take the loans when you get to certain cash value areas, certain cash value breakpoints, and you start using that to pay off your debts. Okay. It's called a waterfall. Okay. At some point, all your debts are paid off from your loans coming from your own asset that you're paying back or not paying back. My suggestion is you pay it back, because you're not only earning interest on the money, because the banks, if you get the correctly structured life insurance policy and you've got $100 in there and you take $50 out, you're still earning interest on 100. Unlike a bank where you're only earning interest on 50 and paying interest on the loan of 50. You're not doing that inside the life insurance policy. It just stacks on top of each other. Okay.
Yeah.
At some point in time, you got a bunch of cash sitting there. You have no debt, and you got a death benefit. Okay. So these are the living benefits. I hate calling it, a death benefit. Okay. Because that has a connotation that, you know what, I don't get a benefit from it. It's just my heirs. My survivors. You want to look at the living benefits in it. So, a properly structured life insurance policy can be a Swiss Army knife for financial services. It lets you do a lot of things inside the policy, but because you've got those guarantees, you can do so much more outside the policy. You can take a lot more risk in your investment portfolio because you've got this fixed piece right here. So it's just a different asset class. I do not want to construe life insurance as an investment. It is not an investment. Never, never, never construe that. Anybody telling you, you can create your own investment inside of a life insurance policy, red flag. Understand what you're buying. You're buying an insurance contract. Okay.
And thank you so much for mentioning that, Mark. That's one of my biggest concerns, and one of the biggest things that I found that turns people off to insurance. And maybe the reason that most people don't even want to talk about insurance is because the amount of skeezy people out there. And you and I have spoken off the pod many times about other people that I've unfortunately worked with or met in my life that lead people astray. Is there a way that our audience member, if they are thinking like, hey, I do need some sort of a life insurance provider, maybe Chris isn't in my area, or I'm afraid to reach out to Chris for whatever reason, how can they find someone that they can trust? Because I know that right now they're trying to pass the fiduciary standard for brokers and for insurance agents, but that's not passed yet. So right now they're only working on suitability standards, not best interest standards. So
Right.
how can people find someone that they can trust and that they actually know? Is there a question they could ask? Do they just have to keep on? I think that's the hardest thing.
I think you need to interview at least 2 or 3 people. I would talk to successful people in your network and find out who they're working with and ask for a referral. That's probably the best way to find somebody. Look at their designations. Have they done the time and gone through? Do they have a CFP? Do they have, if you're looking at retirement planning, an RICP, a retirement investment or retirement income certified planner? Are they an IRMA certified planner? Do they have a CLU, which is a chartered life insurance underwriter, or a CHFC, chartered financial consultant? These are things that you have to get a life insurance policy. You have to get your Series 63, Series 6, Series 7, or if you're doing, like Chris is doing, a Series 65, which is a registered investment advisor. There's education that goes there, but that's the basics. Are they doing things in the field that they're going to specialize in that gets them that additional education, the MBA? Okay. Now, that said, just because they got an alphabet behind their name doesn't know that they know how to put it to work. Again, you cannot be an expert in all things.
Absolutely.
So ask
means
those
you're really
folks
good at
that are in
taking
your
tests.
network that have done well. Ask them for a referral. That'd probably be the best way to start. And just because mom and dad work with somebody and they're friends with the family doesn't necessarily mean they're doing the best job. So do your own research and interview a couple of people. You will know when you're talking with somebody with your gut if you've got a good fit with them or not. Trust your gut.
Interesting.
And ask them questions. How would you suggest I do this? And if one person's ideas are completely different from another's, doesn't mean it's wrong. But investigate it. Do your homework. It's your money. Okay?
Yeah, I think that's the hardest thing for a lot of young people is that they want to just find the professional and they're not taking ownership of their life. They're hoping that the professional will do it for them. But ultimately, I even tell my clients this, no one is going to care about your retirement more than you are. Like, I care. I care more than any advisor is going to care. But I can't care more than the person who wants to retire in a year.
Right. And understand what your fees are going to. Don't go with the lowest fee. Okay? Don't go with the highest fee by the same token. If somebody's telling you, look, I'm a fee-based only planner, well, how do you ask them? How do you deal with risk protection? Who do you go to for insurance? If they're not writing insurance, why not? That's the whole part of the financial holistic plan. They're probably very good at building an asset bucket. But what are they doing to protect that if something should go wrong? Okay. And maybe you want to keep working with that person that's doing your assets, but find somebody to partner with on the risk side, on the insurance side, same as you would with a CPA. Okay. And they don't all have to be in the same house.
Be nice if they were.
I typically find CPAs that have advisory platforms are ultra conservative. If that's your bucket, go for it. If you want to find somebody that's going to tell you how the Augusta rule works, your typical CPA and a financial advisory plan is probably not going to be willing to talk to you about that because it's something out there that might get you an audit. Well, if you've done the right job in bookkeeping, an audit's fine. Okay, don't be afraid of an audit. Just keep good books, keep good records. I'm not suggesting you go out and look for it by any stretch of the imagination, but
it's a lot of work. It's a lot of time.
It is. But you have to do the homework, like Chris said. Nobody's going to give as much deference to what you are doing in trying to build a retirement plan and put the protections in place until you get to retirement than you.
Okay.
So someone
find a good. Oh, should I go? Go ahead, Tom.
Thanks, Chris. So someone who's, let's say, like your son, 22, still in college or fresh out of college, what steps could they get to, or should they be taking at that first stage, and what should they be looking for in like 3 or 4 steps?
Like after they graduated from school, or even while they're getting ready to graduate from school.
I mean, your son.
I've got one son who is, he's in the second year of college. When he's working, working, full time during the summer. He's already putting money away. He's already got a Roth going. Okay,
perfect.
Like I said, we're looking at doing some life insurance with him, getting as much as we can now for 20 or 30 years, probably 20 years, because he'll convert it way before then. Disability would be hard for him until he gets out of college Okay. Now my other son's going to be playing hopefully D1 sports, so he might get some NIL money and have some disability coverage from that. But that's a completely different story. That's less than 1% of the population at that age. So when they get out of school, take a look at what your group disability coverage is at work. Compare that to what you could buy on your own. Many times you will find that you can get a richer individual plan that's portable if you leave that employer. And if you ever have to get the benefit, the benefit's tax free. Okay.
All right.
All right. Most companies that have a short-term plan will have a long-term disability plan too, but a lot of them don't. Okay. So even if you've got a short-term and a long-term plan, ask for what's called the certificate of insurance, because it's a group coverage. You don't have an individual policy, and take that to somebody that understands how to read that. So that's an insurance specialist, and you will find that you don't probably have as much coverage as you think. I can remember just 3 years ago, I had a group plan, and we looked at it, and I was making, north of six figures. Okay. My max policy would have paid me $1,300 a month in a short-term disability scenario. Now, I wasn't paying for it. My company was paying for it, but,
that's
not a benefit that's going to do anything for me.
Yeah. Yeah.
Okay.
Absolutely.
So look at
definitely
something that you can take with you that is individually owned, that you're not going to pay taxes on if you need the benefit. Okay. And there are certain things you can look at in there where, okay, I'm starting out as, a newbie in my industry. Take the medical industry, for example. I know my income's going to pick up once I get through my residency. I know it's going to pick up again when I get through a fellowship. You can buy certain disability policies that have built-in step-ups that are guaranteed once your income's hit certain thresholds. Again, complicated. Work with specialists.
Work with that's the mantra of the pod. Work with a specialist. Yeah.
Everybody in the insurance industry, the financial services industry, is worried about two things right now, and I don't think we got a lot to worry about. I think it's a lot of hype. One, these AI robocallers, are they going to replace financial planners? No, they never will. Anybody that uses one of those is doing themselves a disservice. And number two, the fiduciary rule that the Department of Labor is trying to push out. I think it's a huge disservice to the consumer, and I think it's a lot of smoke and mirrors. But that said, there needs to be something in place to make sure that recommendations being given from all sides of the financial services platform are suitable for the client. But what's suitable today may not be suitable 5 years down the road, and that's where the problem is. You got to look at planning, not transaction. Okay.
Yeah, and I think that's the hardest thing. And I think that's the reason that I fall so much towards, we're always going to go term first, because like you said, term gives us the ability to be nimble because we don't know what the future holds. The biggest thing that concerns me when someone talks about using like a waterfall trust or being your own bank, the infinite banking, is they're saying, go and buy a whole life policy right now, even if you don't have the money, because you're going to be able to borrow against yourself. And then you'll see people who buy a policy that is only making the broker a bunch of money, and they're not able to take any money out because all their money is going towards just funding that policy.
Right.
That's why when you do term, you have the ability to later on you do term and you invest the difference with the knowledge that in 20 years, 15 years, 25 years, you can pivot and do whatever you need at that time because no one knows what the future holds.
Exactly.
But I like having optionality.
Yep, absolutely. Protect the foundation, make sure it's reinforced, and then you can do whatever you want to do down the road. As your income grows, you get more flexibility, but you got to put the foundation in place first. And the other thing I would tell you too, when you're looking at term insurance or you're looking at any other type of insurance, don't fall for this fee only. Oh, we don't take commissions and we're a fee only. Commissions are not the devil. It's not a bad thing. If you look at somebody who's charging you a fee on your investments over the course of the next 10 years, multiply that fee versus the commission that the agent's getting to service that contract for the next 10 years. He's getting it up front in many cases. Sometimes there's a trail, but he's getting that up front because he's not getting that 10-year fee. So if I'm getting a 1% fee for 10 years versus an 8% commission up front on a contract that's got a 10-year surrender charge, Is the client coming out ahead either way? Make your own decision.
Yep.
Okay. But there is a place for fee only and there's a place for commission. And you have to find the happy medium for both. So when the government comes in and says, we're going to mandate that you only do it one way or the other, you know, the old adage, hey, I'm from the government, I'm here to help. Turn around and run.
Exactly.
Yeah. Okay. What other questions are you getting from your clients, Chris?
I think that's the biggest one is the insurance one. I have gotten a few about the infinite banking and how do I do that. But unfortunately, the reason that I get that it's people who don't have a lot of money right now. And then they're basically getting sold the narrative that if you do this, you can borrow against yourself to purchase things.
Right.
And,
put $200, $50 a month in here in 3 years, you can buy a house. It's not going to happen, guys.
To which I tell people, like you said, insurance is not an investment. It is mitigation of risk.
Exactly. Now, can you use insurance as a tool to fund other things? Absolutely. Yes. That, believe it or not, is part of the problem we've got in this country and most of the world is financial education. What people don't realize is, when, I'll ask you this, Chris, when did they first start regulating mutual funds?
Oh, I have no idea.
1940s. Remember the 1940 Act going through your training for mutual funds? Well, you got 65. While, so, okay, 1940. What did people do before that? In the 1800s, the early 1900s, they bought life insurance. It was the number one financial planning tool. It's a tool. Okay. When you look at the Rockefellers, okay, they wrote a book, I believe it was Rockefellers, called The Waterfall Trust. What did they use to fund the trust? They bought as much life insurance as they can on everybody in the family. And when one of them dies, the money went into a trust. Everybody else used that money to buy more life insurance on the future generations. It went into the trust when they passed away. Now, when the family needs money, what do? They go pull money out of the trust.
Yep. And that's great if you've made the money to be able to do
Correct.
that. But the biggest concern the thing that I don't like when I go on TikTok, or I don't go on TikTok, but on all those social medias is that people are saying you can get that right now. You could be a Rockefeller if you do this without first saying, but in order to do that, you need to make the money first.
Right. And you have to have the foundation in place to be able to do that in case something goes wrong while you're trying to become a Rockefeller.
Yep. You can create that generational wealth. It just takes time.
Yep.
And people don't want to focus. They don't want time. They want it right now.
Right. And you're not going to create generational wealth if you're putting money into a life insurance policy and then turning around in a year or two and starting to pull cash value out to buy a boat. Okay. That policy is going to blow up. Okay. So structure it correctly. Ask the questions. Ask the question, hey, if you're showing me on this IUL illustrations, Index Universal Life illustration, if you're showing me a 12% rate of return, what's going to happen if I'm not getting that 12% rate of return? What happens when my rate of return falls to 4%? Am I still going to have insurance all the way out to age 90 or 100? If that contract's not going to guarantee that out, start asking questions. Okay. Maybe you don't want to plan on it going all the way out that long. It's case by case scenario based, but don't buy off the illustration if they're showing you some ridiculously high illustration, because all those indexes are back tested and they can tell you what that index has done in the worst 10 years, in the best 10 years, in the most recent 10 years. Take the worst 10 years, cut it in half and make sure it would still perform. That would be my recommendation at a minimum.
Yeah, I think the biggest thing I'm taking away, Mark, is when it comes towards insurance, it's trying to do it on your own. While it might save you some money, could really hurt you in the long run because you don't know what you're doing. You don't know what you don't know.
Exactly.
That's where coming and working with a professional can really be helpful. Work with me, work with anyone, but just make sure you work with someone who has your best interest at heart.
Right.
Ask the hard questions. See if they have some designations, or if they don't, are they going to bring someone in like I do with you, Mark, where I bring someone in who is a professional, and I'm just here to look at the holistic picture.
Right. Well, I mean, to your point, if you look at the average rate of return on the S&P 500 or the Dow or the NASDAQ, I guarantee you over a 10, 20, 30-year period, it's higher than an individual investor trying to do it on their own. There have been study after study after study done. Individual investors, what do? Do they buy low and sell high? Or do they panic? And get their emotions involved with it and do the exact opposite. That's why the individual investor on most of the reports that you'll read averages somewhere between a 3 and 4% rate of return on the high end. Okay. That's gross of fees. Okay. Now, does that mean that there's not an outlier? There's going to be somebody on here that says, man, I'm killing it in the Forex market. Okay, you're an outlier. But what are you doing with that money? What are you doing with the other side? And how long have you had that success? If you've had it over the last 3 years, get ready.
Yep.
Get ready, because we're going to see some troubles ahead.
You know, we have that all the time of someone saying, why would I invest in the S&P 500? Why would I do that when I'm making this much money in this last month? It's like, what'd you do the month before or the month before that?
Right. And what happens when the market drops? Okay. Me, personally, I want a floor. I don't care if I don't get the 30% rate of return. I'm happy with 15 every single year or 10 every single year, knowing I can't lose. And that's what the insurance products we're talking about give you. Okay. But having that floor lets you take more risk in your brokerage account. It lets you go after that IPO. Yeah. I'm not saying don't do that by any stretch of the imagination. I've made some money over the years in some IPOs and looked at some particular stocks and made great returns on it. Okay. But make sure your risk management,
your risk management needs to be on point before you start going out and before you start swinging for the fences on every one. You got to make sure that you're up a little bit.
Yep. Yeah. And there are plenty of people out there that can help you with it that are very versed in it. You just have to ask the questions and you have to do your own homework.
So first step, if someone is interested in this, is reach out to someone who is close to you. You can always reach out to me, Chris at Mons on Wealth. I'd be happy to, you'd be on a conference call just like this with Mark and I, and we'd be figuring out what's right for you. Now, Mark, before we close out, we are a podcast. We are the Fi Guys, all geared towards financial independence. So we always like to ask our guests, what does financial independence, financial freedom, what does it mean to you?
It means having the ability to do what you want, when you want, how you want, because you've got the financial background to pay for it. So, a lot of people say, I want to grow up and have FU money. Okay. What does that mean to you? Does that mean I need to have $1 million in the bank? Doesn't it mean I need to have $5 million in the bank? If you listen to somebody like a Grant Cardone, I think he's got a pretty good idea of what he's talking about, especially if you're a business owner. If you've got $1 million or $2 million in the bank and all of a sudden you get, a lawsuit, is that going to cover it? No, you got to take money out of that to go forward and pay for that lawsuit, even if you're 100% in the right. So what's that number to you? Well, it's probably north of 5 million. That's a staggering number for somebody coming out of school. But guess what? If you work with somebody like Chris, if you put the foundation in place, you make the right investments on a periodic time, whether it be monthly, quarterly, annually, don't take that tax return and go buy a new boat. Use a portion of it on a boat, but put some of it to work so you can get to where you want, so you can get the bigger boat and pay it off later on. Okay. So financial independence to me is the ability to do what I want, when I want, and have the finances behind it to cover it. If I want to pick up and go to take my wife to Paris, or if I want to trade up my car, or if I want to make sure that my kids are going to have college paid for, I've got that. I've got one going into college. He wants to buy a fourplex.
Nice.
Take 3 of those 4 rooms and rent those out to some buddies. Great idea. Get involved in real estate.
Yep. Do some house hacking.
Yep.
We love doing that.
We love the house hacking over here.
Yep. The other thing I love about your podcast, you tell them how to use the rewards, how to look at your credit, understand how your credit works, understand where you're putting your reward points, because you can build wealth with that too, because you're not spending the money elsewhere. That makes sense.
Yeah, definitely. Absolutely. Yeah, it's a free return on investment. And then, Mark, what is the best way for our audience members to work with you if they really gain value from what you said today? What's the best way for them to get in contact with you, to work with you, to be sure that you're helping them out with this process? Because as we've shown, it can get complicated really, really fast.
Yep.
And someone going alone might not make it through the jungle.
Exactly. The best way to work with me is to talk to Chris. So pick up the phone, email Chris, Mons on Wealth Management, or Wealth. Was it monsonwealth.com?
Yep.
Okay. I'm a wholesaler, so I'm not working with the retail client individually, but I work with them all day long through the advisors that I work with. Okay. So Chris will come to me with, I got a guy, and if you're that guy, we might end up on the phone talking together.
Yep.
Awesome.
I hope so. Mark, do you have any questions for Dominic and I before we sign off today?
No, I think that the original question I had is, what's the question that's coming in from the folks that are listening to Fi Guys? And you said it's the insurance. How much, when, and what? I think we covered that.
I think we did. So, Mark, thank you so much for joining us here on the Fi Guys today, and I hope you have a great rest of your day, man.
Hey, it was my pleasure, guys.
Thank you, Mike.
Thank you, Mark. And with that, Mark Massie has left the building. Dom, I can't wait to get all into this on Friday's 5 Friday feedback. But what'd you think about the conversation thus far?
Loved it. I took so much from this episode. I don't want to spoil anything, but we're going to have him back in the pod. We got to have him back. We're going to have him back. I can't wait to get into this on Friday. I love it.
We'll get all into that. If you found value today, please tell a friend about the Fi Guys. Remember, it is better to go on this journey with a friend than going alone. And until Friday, we'll see you next time. Later.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.